everyone. I'm Katina Scott, Chief Investment Officer for Mariner Wealth Advisors, and I'm joined here today with Jeff Krumpelman, our Chief Investment Strategist, to present our 2021 Crystal Ball Outlook. Jeff, this has fast become an annual tradition and exercise that I very much look forward to participating in with you. So welcome to you. And welcome to all of you that have joined us here today. We really appreciate you taking the time out of your busy schedules to join us for this discussion. And so what we're going to do today is conduct a quick review of 2020 and highlight some of the key observations from some, rather rare and historical significant events that occurred last year. But more importantly, we'll get rather specific about what we see driving the equity markets in 2021 and our associated targets for where they're headed from our perspective. Before I kind of jump into comments, how this is going to work is I'm going to finish a quick overview here, and I'm going to turn it to Jeff to answer several questions for us. We will leave some time at the end, hopefully, to answer a few questions if you have them. So please feel free to use the question box to submit those. But kind of back to the regular comments, Jeff, I know that just starting to prepare for some of your remarks in the investment strategy commentary that's coming out here shortly, you actually quoted John Maynard Keynes and noted that he had once said that it's better to be approximately right than precisely wrong. And I think those were good words to highlight because it just really reminds us that economic and financial market forecasting, while grounded in research, can really be more art than science sometimes. And so I just wanted to echo those sentiments today as we prepare for this conversation and remind you all how we really assess the state of the markets. And when we do that, we really look to evaluate the fundamentals, valuation levels, as well as the technical trading backdrop to determine the likely trend of the market. And yes, while we do publish these specific targets for economic growth as well as projected price level of the S&P 500 each year, we believe if we can simply get the trend right, generally we find that success in the markets follows suit. And really last year was a great example of this.
Yeah, no, I completely agree with you, Katrina. And I think we have a slide that kind of captures some history about how the market has traded over the last 20 or 25 years, the years that were positive, those that were negative, and then corrections in red. Yeah, here you have it here on the screen. And so in prep for this presentation this morning, we did go back and we took a look at what we forecast this time last year for 2020. And I think it's kind of interesting what we were suggesting last year. We had a 75% probability going into 2020 that we would see positive returns. And we had an upside price target of around 3,500, which was about a 12% total return for the year. We had a 25% probability that we assigned to kind of negative consequences. And I think we had a downside target of about 2,600. So it's always good to go back and reflect and see, well, what actually did happen? And how does that fit in with historical context in this idea of blending art and science together? And the upside, or where we ended the year for the S&P 500 was 3756. And that was about 18% upside. So we were a little light, versus what actually happened, but we did get the trend right. And I think it's pretty interesting that even though it was a pandemic, a year of a global pandemic, and a really ugly election that won't seem to go away, our downside target of 2,600 was kind of within range. We ended up down at the lowest point, a little below 2,300. But we got that range right, and more importantly, we were approximately right and got that trend right. And I think that we were really pleased. We had high conviction. We maintained our message of hold your ground in the midst of a period where we were kind of tested back there in the spring, and many people were taking their price targets down. But one of the reasons why I have this chart up here is just to show you that, you know, there really is historical context. It's not like we're just winging it here. We do look at the fundamentals, the valuations, and the technicals to assess where we're going to go. But this idea of being biased towards the positive, about 75 to 80% of the time, the market is up, and you can see it in these gray bars. There are rare occasions, call it, you know, 20, 25% of the time, where the market is negative, and you see those periods in which it is. But look at that. Rarely is it really outrageously negative. Most of the years in which it's negative, it's modestly negative. So, you know, I think that you'll find we are not rose-colored glasses investors that are always positive. We're not, but we're going to rely on the fundamentals, the valuations, and the technicals to take us there. We felt they were positive. It was the policy, the aggressive policy that we saw coming in the spring of last year, and then the stabilization in the economic data that we saw playing out, likely to play out, and then actually playing out, that kept us positive about the market. And we continue to think that it's constructive for 2021.
So just moving on to this next slide here, I think it really just kind of summarizes a lot of what you just said, especially as you talk about the holding our ground and in the conviction that we did have. I think that, you know, it really helps us to paint the picture for what we all experienced and remember in the first quarter of last year. In looking at this, you know, the second column here, in the data that we see from February 19th to February 23rd, you look at that and you can see that the pullback, the severe pullback that we saw in that first quarter with the S&P 500 and other equity indices each falling 30% or more, which really are magnitudes of decline that generally we see in multi-quarter or multi-year bear markets, not in 1 month corrections. And obviously this happened as people were starting to socially distance themselves because there was a growing awareness and concern that this pandemic was underway. Yet, as you said, in our research, we developed a strong conviction that we believe this was simply a temporary economic shutdown and a related market swoon to invest in our health, rather than a more typical business cycle issue that tends to end, you know, bull markets and does lead to these multi-quarter you know, bear markets. So, you know, we consistently stated that we felt that the aggressive monetary and fiscal stimulus would help get us through that soft patch and see a reasonably swift recovery. I think what we didn't necessarily anticipate was just how much it would recover. And looking there in this third column then on the recovery from March 23rd to year end, you know, is broad based across all segments. And you can see that these indices all recovered and advanced 70 to 90% off that March low, which was just, you know, significant. And so as we look back through 2020 and what transpired, absolutely, we're pleased that our conviction to remain invested, you know, help clients avoid suffering from whiplash and, you know, frankly, the regret of missing the strongest rally off a low like this on record. So, you know, that in a nutshell kind of helps us to see what happened in 2020. And the fun part for me here is that I get to do the looking in the rear view mirror and telling you all about what transpired last year. And now we're going to put the pressure on Jeff really to talk about what's going to take place as we move into 2021.
All right, well, I'll see if I'm up to the task on that, Katrina, and I'll give it my best shot. But, you know, before leaving history, I just add it really was a wow in the market for returns. And I think that does help demonstrate that since this occurred in the middle of a pretty significant wall of worry, concern about pandemic, concern about election, it shows how the market is forward looking. and it discounts what it sees happening, months and quarters down the road, and responds in advance of that. That'd be point number one, and that is, I think, important to think about when we look at 2021, because we have some good things to look forward to, such as vaccine deployment, and perhaps additional fiscal stimulus and other things, certainly an accommodative Fed. So there are things to look to in the future that will drive returns, as we move through 2021. But the second point would be the breadth, as you pointed out. It is confidence building, and it's a positive signal that, yeah, the S&P 500 was up 18%, but wow, Russell 2000 up 20, and you see that internationally, we also had nice returns there, not as robust as you saw in other segments, perhaps, but nice. And then you saw good recovery in all of those different indices from March through the end of the year. So the breadth is supportive. NASDAQ, international, small cap, all these things did well. That said, all this strength, the one thing that did surprise us that perhaps is a little sign of being measured or cautious about getting too giddy about returns for 2021 is the fact that, yeah, we've told people to hold their ground. We had a target of 3,500 that we didn't take down in the midst of all that stuff when people were going to 1,800, and counseled clients to stay invested. But we are surprised with the swiftness. This is the swiftest recovery that we've seen on record. And so if anything, I think that we're a little more measured going into the year. It's great that we have vaccine deployment coming and the cavalry's on the way on that front. But perhaps some of the returns that you would have expected to occur in 2021 have already occurred. We think there's additional upside, but we don't think the returns are going to be dazzling. We think that they're going to be measured and healthy, but not eye-popping. And that's kind of a commercial for what's to come here.
All right, Jeff. I think now we're going to switch gears just a little bit more and really start moving here into the putting some more pressure on you and getting a little bit more specific around our layout for our base case and some of those likely alternatives.
Yeah, no, that's great, Katrina. And I think as we look at this page, which is something that we put out every year, and we do update it, through the year, but put it out at the beginning of the year, which really is the forecast. And again, I just encourage everybody, as you see these numbers, we're expected to do this, to have some kind of measure or target that we're looking at, but we're really just trying to get trend right. And a repeat of last year, if we can do that, we'll find that our clients are successful. But let's talk about the different scenarios. The first thing I'd like to say is you see our base case in green in the center. And if you look at the base and the optimistic case and you add the probability of those two, 55 plus 20 is 75. So the way I look at this and the team looks at this is we assign a 75% probability that we have positive and healthy returns next year. We assign in those two other cases, 15 plus 10 is 25, we've got a 25% chance that we have, modest to negative, mediocre to negative type of returns. And what I'd like to do is bring to life why we lean, as you saw in that chart before, 75% positive. There's historical context, but there's also the fundamentals, the valuations, and the technicals that take us there. So the assumptions for our 75% positive kind of outlooks are GDP that continues to recover through the year, but in measured fashion with about 4% growth. Also built into this is that you get vaccine deployment, maybe with a hiccup or two. We're already behind the curve on that as opposed to original expectations on how much of that would have been distributed so far, but that's to be expected. But no major setback like mutations that the vaccine's not, successful at treating, that you don't get some kind of major logistics issue. with the drug distribution or the vaccine distribution, if you will, and that goes, okay. And in that scenario, we think that you'll hit consensus earnings somewhere around 196 in consensus earnings is what's out there, and you assign a 20 multiple to that, that gets you 3,900 thereabouts. And actually, we're looking for multiple contraction in that base case. We're currently at 23 times earnings, so it's somewhat, I think, conservative in saying we get a little bit of a moderation in the PE multiple. Now, there are several firms and strategists out there that are way more optimistic and have targets of 42, 44, 4,500 on the S&P 500. We do think there's an upside, and if you do get perfection in terms of earnings delivery and you get virtually no hiccups in vaccine deployment, we reopen and everything looks hunky-dory, we do think that it's not crazy to think you could maintain the multiple, or you get a little bit upside versus consensus earnings, and you get a 41.50 or above return. Our base case would come to a 6% return. That 3,900 is about a 6% total return for our base case, but it's a fairly good, probability that we signed to perhaps double-digit return of 13% in that optimistic case. The disappointing case, if I can bring that to life, that would be where you do get, slower than hoped for deployment of the vaccine, and as a result, a little more delayed opening of the economy, and earnings modestly disappoint. They're not 196, they're 190 or a little bit below that. You get a little bit of multiple contraction to the 19 times level, and voila, you've got almost break even, minus 2% type of total return. And then the pessimistic case, in our view, which shows 18% downside, kind of a healthy correction towards the higher end of, a correction is considered to be anywhere from 10 to 20%. We would see that happening again, not an ugly bear market, if you will, but a healthy correction would be in two cases. One would be if it was kind of a train wreck on vaccine deployment and something happened that really did cause extended shutdown and there was an earnings disappointment. Multiples would probably hold up relatively well, not at 23 times, but hold up relatively well. You would just get probably earnings going back to the trough levels that we saw on a 12-month basis of 130, 140 or so, and that would take you to the downside. Or conversely, the other thing that could lead to a pessimistic outcome, ironically, would be inflation finally kind of begins to heat up, and you get an economy that's strong, but you get higher interest rates and inflation, and actually the economy outperforms the stock market. People start worrying about a wage price spiral, and you get significant PE contraction. In either case, that would lead to disappointing result. We only put a 10% probability on that. So you can see we're biased to think that things will continue to reopen and that you get decent returns, but not giddy returns. And I think that's kind of where I'll leave it in our scenario analysis, if you will, Katrina.
Thanks, Jeff. I know that we don't necessarily like to think about the disappointing outcomes, but best to show really how we do kind of approach things, even though we do tend to view things as from a more positive lens at this point, at least. So, but I guess, Jeff, to lastly summarize what you're saying, essentially we see a 75% probability of positive results in 2021 in a constructive backdrop, but most likely high single-digit returns given the strong gains that we have already seen in 2020.
Yes.
Perfect. So I think now moving on to the next slide here. Kick it back over to you.
Yeah. So, I wanted to show a couple examples here. This is a great case where people will talk about, hey, is this a sandcastle in the sky? We've gotten a 70% move off the bottom in the midst of some pretty negative news. We've got disconnects and has the market just got significantly ahead of itself? How can we get a repeat? And what I wanted to do was provide a little perspective on that. It is true that the S&P 500 has deviated significantly. It's well above its 200-day moving average. And whenever the S&P, gets at these levels above the 200-day moving average, people get, really concerned that it's ahead of itself. And yeah, it is short-term overbought. And that's why we do think that perhaps you could see rising volatility and a correction here before you move on to higher highs for the year and those nice positive returns. That said, that doesn't have to happen. And in fact, this momentum that we've seen in the market is supportive of a strong year in 2021. And this is a slide from Strategist. I could show you percent deviation from 200-day moving average. I could show you the percentage of stocks that are at 3-month highs. I could show you the percent of stocks that are in long-term uptrends. All of them show that there's been tremendous strength, good breadth, and good momentum. And this is just one of the examples. Historically, if you look over on the right-hand side of this bar chart, we are in the 10th decile. So it's been very rare where you've seen the S&P trade at this level above the S&P. And in fact, we're in the 10th decile amongst history on that measure. But you can see when historically that's happened, 12-month forward returns on average are a positive 11.2%. So, we're not calling for double-digit returns in the market. I said our base case was 6, but they certainly are not out of the question. And just because you've had strong momentum, not only does it mean that you're not doomed to poor performance going forward, historically, it's meant that you're set up for solid returns. So we're actually a little more conservative than if you just looked at the technicals and said, well, this happened, ergo, that means based on history, you should see really healthy returns. So I just wanted to put that, in context. I think also this next slide, the other thing that happens is, folks start worrying that this is a top, it's got to be a top when you get this level of momentum. And, there are 9 or 10 different measures that we kind of look at, or signals to determine, are we at a top? Does it feel like, based upon what we've seen history in terms of signals, that we're there? And if you look at these 9 measures, the green check means that it's not signaling a top. If you had a red X, that would mean it is, and we have only one that's a cautionary signal, and that's IPO activity. So that is a bit peakish in nature, and you should expect that when you've had these kinds of returns in the S&P and this kind of recovery off of a bottom. But if you look at in terms of just heavy inflows into equity funds, you don't see them. You still see more flows into bond funds on a 12-month basis than into equity funds. We have low interest rates. We have strong earnings revision. If you look at leadership, it's been strong. It's not been in the defensive areas, and the credit markets look pretty good. So, this is another thing that we monitor. If we were nervous about things getting toppish, we'd have a lot of red X's here. So that should provide some context as well on these kinds of measures that we monitor regularly.
No, that makes sense. Thanks, Jeff. I think now maybe we'll have you quickly cover where we stand on some of the factors that we look for to signal tops in more detail, things like flows, rate levels, credit spreads, and even leadership in the market.
Yeah, I guess we're just saying, don't take my word for it. So if you look at this slide, shows you flows into equities. Obviously, when the blue bars are going up, that means we're getting positive flows. When they're going down, we're getting negative flows. And then you can see what's going on with bonds. And this is through October. Those blue bars would start to look somewhat positive, not on a 12-month basis, but on a month-to-month basis. And the 12-month number on equity flows that negative bar will get a little less negative, but they're still negative. And so people have still net been liquidating equities, and they've been buying bonds. So this is not signaling your typical top on this measure. And if you go to the next slide,
No, hang with me a second.
I'm bearing with you.
Trying to get my mouse in the right spot here.
It's just a good thing I'm not doing this.
Well, you just have to be kind in front of all these people. Here we go. Is that the right one?
Yeah, that's the right one. So, we talked about levels of interest rates. Previous times when we've gotten towards tops, you'd think of the tech bubble. I mean, you're talking about interest rates at, 6% levels plus. Just want to make the point that while yields have been coming up, and, I think we've kind of been wishing for that. You don't want to see surges, but you want to see rising rates, and it would be nice to see the bond market thinking growth as opposed to lack thereof. They're still at a little over 1%. So, not very typical to see these low level of rates if we're getting close to a top. And I think the other factor that we might have in here that we wanted to show, we've got two others. One is credit spreads. Here's your credit spread. So here we're just looking at high quality corporates, the spread of low quality over high quality corporates. You can see spreads are really tight. And I've always said the bond guys are way smarter than the equity guys. And when the bond market's concerned about recession, you see these spreads widen out, and that's just not happening. So that's very favorable. And recessions are what end bull markets. So it doesn't look like double dip is going to happen. I do expect a slowdown in the first quarter, but with the pent-up demand we see, the stimulus we see, and also the vaccine cavalry on the way, recession signals are not out there. Got one more, I think.
Yeah, one more on the equity markets here.
Right. So this again, is one of the elements that we look at for signs of a top. This shows you the performance of the Russell 2000 small cap stocks, the percentage of those stocks that are above the 200-day moving average, 34% at peakish levels. That says investors are willing to take some risk here. They're not hunkering in on defensive stocks. And typically when you get close to top and you start to roll over, you see a move towards the defensives. And there are other measures and indices we could have looked at that gives you a sense for sentiment out there as expressed in leadership and what people are buying. Commodities are, on fire and doing extremely well. Your technology-oriented names in the NASDAQ doing extremely well. So if you look at staples and utilities, they've been the weaker area in the defensive area. So certainly leadership in the market also doesn't signal, hey, let's move away from exposure to stocks at all. That kind of rounds out the signals of a top.
Yeah, it does. Thank you for doing that. And in there, you mentioned a little bit about just headline risk. So I think that's a good segue to move to another part of the conversation, and just to talk a little bit more about what are we going to be watching, and talk about some of those things that are going to keep us, measured and cautious, or maybe even sober into the new year.
Right. So, we're going to hit the wall of worry in just a second. And before we did that, and we will highlight for you the headline risk versus what we're watching. Forget the headlines for a minute. Just going into that wall worry list that causes all the angst, I wanted to have a quick summary page. We follow 3 levels of analysis in answering client questions about where do we think the market's headed. We look at fundamental trends, we look at valuation in the market, and we look at technical price trends that includes things like momentum, breadth of the number of stocks that are contributing, and performing, and then just sentiment itself, percent bulls versus bears, and other measures that get at that. And if you look at those three categories, I just want you to see that there's a lot of positives, there's a couple neutrals, but you don't see a lot of red negatives in here. And that again is important. So within fundamentals, when we talk about fundamentals, we're looking at things like the trends in the economy. We look at all measures and bills all over that. We look at earnings trends, we look at Fed policy, which is accommodative, the level of interest rates, all these things, credit spreads we just talked about. They're positive right now. If we look at valuation, a lot of people will get a little moody and a little crabby on valuation. And we've got to be careful on valuation because from a PE standpoint, we are getting at peakish levels. I mean, we're at 23 times forward earnings. That ain't cheap, that's healthy. But what keeps us saying this is reasonable valuation, and it kind of gets at what you want to look for to make us change our mind on that, are rates. And specifically, if you look at what we call the equity risk premium, which is the earnings yield on stocks, less the bond yield that you can earn by investing in the bond market, that's over a 200 basis point spread. So the earnings yield is 2% higher than the bond yield. That means that stocks are relatively cheap on, compared to the interest rate that you can earn on bonds. And so as long as that's the case, that's a real positive. Now, if we saw a big surge in rates and inflation, that would make us a little more cautious unless that was accompanied by a pretty good surge in earnings, but we already are expecting a pretty good surge in earnings. So right now, high on PE, but very attractively priced relative to bonds, and we do expect yields to be measured in their rise and not go to scary levels, but we'll be watching that. So reasonably priced there. And the technicals we just went over. It's example after example that I could give you where, yeah, short term we're overbought, but these are really good signals when you see this kind of breadth, this kind of momentum, this kind of leadership. That's really good for the market over the next 12 months. So that sets us up positive, neutral, positive. That says in a soup bowl we're positive. But as you say, Katrina, what is there for us to worry about? And that's what this next slide gets at. So our clients are going to be picking up the Wall Street Journal and Barron's and just Googling stuff and watching, I don't care if it's Fox or it's CNBC or whatever. They're going to see this. Vaccine execution risk, mutated strains in the UK and South Africa. They're going to read about hospitalizations that are peaking, and California can't take any additional now patients unless another patient leaves the hospital, and that's going to cause some volatility. We're going to have debates about, okay, what is Biden going to do? Are we going to get $2,000 in direct payments to consumers or not? And the greater the risk that COVID is spreading, the more important it becomes that we get fiscal policy, and that goes well. Those discussions go well. Capital and what happened this last week, and today perhaps we're going to see a second impeachment of a president, first time that's ever happened in history. That's some pretty I don't know, scary stuff, I'd say, and can be very depressing. And then finally, regulatory risks. Yeah, we got a lot of stuff going on in the United States. We've got stuff going on internationally with China and what they're talking about in terms of regulating Alibaba and others in the internet space there. We think that all of these factors actually can be managed well. And I think when you particularly look at political leadership transition issues and things like the Capitol, historically when that stuff has happened, whether it's the Cuban Missile Crisis or what have you, the market has pretty much absorbed those kinds of emotional issues and has tended to focus on the stuff on the right, and that's what we focus on right now. And they will be our signals for how we feel about things. So in terms of economic growth, I said, hey, we're looking for 4% GDP growth next year, earnings of 20%, and that going on while interest rates are low and credit spreads are healthy. So, and let's add in there that fiscal policy has been supportive, and so has monetary policy. So as long as that's the case, we lean to the positive. Now, there are a couple wild cards down there, which are geopolitical risks. And, that can be things like, Russia, China, Iran. That's a who knows, and it's hard to build, who knows. That's hard to build a investment strategy around that stuff. You kind of have to deal with it as it comes and see how that might impact the economy. Brexit you would have thrown in there, and that was a non-event from an economic standpoint. So we don't know what those wild cards might be on that front. But the other one is inflation. And I do think that matters because since PEs are at 23 times, it matters if inflation would get away from us and surge. We don't see that happening. It averaged 1.6% last year. We're trying to get it to, if we can have that happen. And I think that we're in fairly good stead on that front. But that changes the picture if the Fed's behind the curve, and we will be watching that as a wild card in a big way.
Thanks, Jeff. I always enjoy, going through this slide with you of the wall of worry items, particularly as headlines do seem to be driving a lot of, emotion for investors and clients. And we certainly can't ignore those, but I think reminding everyone about what we stay focused on. And so I think as we think about some of these items here on the right-hand side, that we monitor as true signals for likely market direction, things like the economic metrics and earnings. I was hoping next that you could just cover some examples of where some of those stand today.
Yeah, I think we'll be pretty quick on these next couple of slides. But again, this is a don't take my word for it, kind of series of slides. So the first one is just wow. I mean, this is a wow. Look at 2020 and the fiscal stimulus that we had, and compare that, to other periods of time where we've gotten major fiscal policy legislation. Wow. I mean, you're talking 3 to 4 times previous peak levels of fiscal stimulus, including 2009. So, the stimulus is equivalent to over 8% of GDP compared to 2% of GDP back in 2009, which was the great, recession. So this is what has enabled, people talk about this disconnect between the economy and the market. There's really not a disconnect if you focus on personal income. And we'll show you some slides in just a minute where personal income, disposable personal income, because of what the government has done through the CARES Act, through unemployment insurance, we've actually gotten higher personal income than we had pre-coronavirus. And that drives savings and spending. These other slides, you got the ISM report here. This is manufacturing and service level activity. You can see the V-shaped recovery in it. If you're below the index reading of 50, that means you're shrinking. If you're above 50, the economy is expanding. And in both cases, both of these measures are well above 50. We monitor them closely to signal recession and concern. It doesn't signal that. CEO confidence is over here on the right. And it's plateaued a bit in here, but it's had significant recovery. And if you get vaccine deployment next year, even if you get a bit of a scare here in the first quarter, then I think that this will bode well for capital spending, and it's just a really good signal. Next slide. New home sales, the housing market has remained strong, largely because of the affordability of it, the low interest rates. That's another reason why inflation would be of concern to us. But this has been a very healthy sector of the economy, a little bit of a slowdown here in the holiday months. Whether that's seasonal in nature, we'll find out here in 2021, but the housing market has been healthy. Here's the personal income slide. And I think you've seen this before. We've shown it in the monthly investment advisor call that we have. The green bars show you the level of personal income over time. And the green bars are higher in 20 than they were in 19 and in previous years. And personal income is what we use to save and spend. So yeah, we had, a number of measures, including GDP, fall off of a cliff and when we shut down the economy, but not personal income, which drives spending, and the consumer drives 70% of the economy. So that remains healthy, and we've gotten another stimulus package here, 900 billion that was just passed, which again, that alone is larger than what we saw in 2020 or in 2009. I'm sorry, in 2009. And with the Biden administration, we're talking about additional stimulus that could come. So this is really important. Then I wanted to separate, and this shows you, I think this is like, is the glass half full or is it half empty? The red bar shows you personal consumption on goods, manufactured goods. That actually is higher than it was pre-coronavirus. So the manufacturing, this is, supported the fact that the manufacturing sector is benefiting, has already recovered above levels we saw previous. It's the service sector, which is the largest part of our economy, which has recovered, but we've not hit new highs on that front. So half empty, half full. If you get vaccine deployment for the bulls, part of the bullish case out there is that you'll see restaurants, bars, hotel, leisure, really begin to improve and catch up with what we've seen in the manufacturing and goods sector. So it's part of the bullish case if we see this happen in a big way, and if you do get successful deployment, it should happen. Labor productivity is something that's quietly just beginning to get some ahas out there. And I just wanted to point out that we've been boo-hooing and, crying about the lack of productivity, and it's a head scratcher, really not understanding it all that much with all this technology we're throwing at things. But it's amazing how productive our workers have been, which has allowed margins to expand in a healthy way. We've got 4% year-over-year growth in labor productivity. And if that can be sustained, that's a wow to earnings growth and to the ability to hike wages without crimping margins. So we're keeping a sharp eye on this. And it's a very interesting element that's happened in the midst of COVID. China, you see the PMI here. What a recovery story that's been. Can you say V-shaped recovery? I mean, I can say V-shaped recovery here. And that's a big part of growth from a global standpoint. So they're successfully reopening. And if this is sustained, that's part of the bullish case. A lot's going on with China. The Biden administration will have its hands full with a lot of things, not just COVID, but with China as well. But I'll tell you, when that economy is lifting, it's good for commodities, it's good for exports, it's good for a lot of stuff. So this is a positive sign. And then finally, we do have some mixed news. It's not, again, we don't want to be accused of being rose-colored glasses people. We're not. The mobility data is beginning to flatten out as we go into this kind of COVID surge that we see. Open table reservations are down, understandably. We're in winter. Restaurants can't do the outside thing. I had friends that went to the igloos at, a local pub here, and they said it was good, but it was cold. So I don't think igloos are going to sustain us here. And it's important to distribute that vaccine. And this is rolling over. And when you couple that with the unemployment data that was disappointing the other day, I think you can overread that. The unemployment data, showed a loss of 140,000 jobs. Most of that was hotel, leisure, in that area. We had growth in retail and in construction and other areas. But this is part of the, we could get a pause. We could get some negative headlines. Let's don't get giddy and start calling for 13% returns as base case, as we have to see how this trend kind of plays out.
Thanks, Jeff, for that recap. And yes, I love that you're pointing out that, yes, I am making you go through and back up the facts with our general consensus comments. So appreciate you doing that. With regard to portfolio positioning, can you talk about, there's always the growth versus value debate. And so I thought it would be helpful if you shared some comments and thoughts around that.
Yeah, even when we do the stuff on Bloomberg and CNBC, we're getting asked this question all the time. So I would imagine that clients are asking this question too. And we've been pretty consistent on this, that we believe that it's appropriate to blend growth and value. And knock on woods, I mean, so far that's been a benefit to performance in 2020. And not so much in the last the closing weeks of the year, but certainly through all but the closing weeks. And we just see it that there's reason to own both. And this is a great example. This is 2016. This chart is 2016 and 17. And the red line captures value versus growth performance. The blue line are flows into value, net flows into value versus growth. And it shows you that after Trump was elected and the election was over in 16, you got this Trump bump thing. And so everyone said, oh, this is the time, let's go to value. And that's happened a lot. There's so many times I've heard, oh, the growth minus value disparity has never been this high. Now's the time. Let's run to value. And old economy stocks do perform very well when you get cyclical recovery, and there are some cheap stocks out there. But by the same token, old economy stocks don't participate all that much in 5G, electric cars, alternative energy, data, and cloud. And we find that there are just a number of companies that are attractively or reasonably valued that participate in these secular growth trends. And it's great to own the FANG stocks, and we've owned Facebook and Google and Apple and some of the big FANGs and Microsoft and so on and so forth. But you don't just need to own those. And there are recent purchases and internal strategies have been broad within technology and levered to some of those areas. And we've reduced our FANG exposure, and we've kind of broadened out within technology what we own, and we want to continue to do that. By the same token, we see cyclical names, and we're pretty particular. It's not necessarily the spit in the wind cyclicals that some people want to run to. It is similar cyclicals that participate in e-commerce and transportation, and that we think have healthy business models. And so we want to blend both together, and we just caution people against getting too caught up in trying to be heroic and run to value. Then from a sector standpoint, Katrina, this kind of backs that up. I guess this is more of a, okay, I'm glad you like the blend. Now tell me again, why do you like the blend? And I would just ask for you to look at, some of the earnings growth rates within information technology. Back in the tech bubble, you got, very weak growth in earnings. In some case, you just had, revenues, and in some case, you didn't have revenues. You just had business models and .com business models. Here you see healthy growth within technology on an absolute, and if you look across the sectors, a relative basis. And the areas that we really have liked are things like consumer discretionary, information technology. We continue to like those. We're selective, but we like certain materials-oriented stocks. Some of them are secular drivers that participate in things like lithium and a new economy that calls for new commodities. Some are, your chemical stocks and your more traditional stocks that are benefiting from this growth in commodity pricing and demand in China. On financials and energy, I'm making comments, I guess, more with regard to internal strategies than anything else. Yeah, if we get a steepening in the yield curve, that will be a positive for financials. But how many head fakes have we had in steepening yield curves as well? So, I can see how financials and energy would participate, but we still like the catalysts that we see in some of these other areas. And it is a blend of growth and value that I just mentioned. Growth models in consumer discretionary and technology. We like some selective healthcare for growth. By the same token, we see the handsome growth in materials and in selective industrials. Notice the growth in utilities and in staples, and just how weak the earnings growth is there on a relative basis. So this is some of the rationale behind our positioning.
I appreciate that, Jeff. Thank you. We are starting to have a few questions rolling in, and I know we're starting to hit the top of the hour and want to be mindful of time. So I'm going to weave a couple in here before we hit our last slide of the day. So Jeff, get ready to really be put in the hot seat with these unprepared questions. But if we don't get to your questions today, we do have plans to follow up with some of them that we won't have time for. But Jeff, the first one kind of goes well with the slide that you were just discussing, and wondering if you could talk a little bit more about the energy sector in particular, and just talk about how its performance relative to 2020 may or may not recover in 2021, or any thoughts that you might have that would provide some color around that topic.
Yeah, I mean, we're like, energy amazingly has gone from, pushing, we'll call it, double-digit percentage of the S&P 500 in the early 2000s to 2% or less of the S&P 500. So it's much smaller part of the equity markets. And in our internal strategies and our flagship kind of strategy there that's run out of Cincinnati, and I'm not speaking for Ken, but I think that he would have some similar thoughts. It's we have one energy stock in there, and we're more interested in new economy commodities and other forms of energy than fossil fuels. So we're somewhat careful in what we think about recovery there. You get a bounce. I think you get a bounce in a rally after being down 40%-ish in this year, and just having such a weak year. And it doesn't take much for things like OPEC to cut back on production, or Saudi Arabia to cut back on production, and you get a bounce in the commodity itself, and the stocks can follow. But we just don't think that in terms of secular growth, it's not a growth story. It's a dividend bond alternative like cash flow, and to own those stocks that exhibit more consistent production and cash flow, that's what we would own. And we're lighter than we've ever been within energy, despite the fact that that's been a soft sector.
Sure, that makes sense, and I appreciate the additional color there. One other question that I think would be interesting for everyone to hear is going back to your V-shaped recovery and the positive outlook in China specifically. Kind of leads us into a question about what impact or what effect do we think that will have on the international markets. And so maybe you could just talk a little bit about our views there internationally.
Yeah, I do think we have had a leaning towards stay-at-home focus. If you would just look over the years, I think more so than peers, and I would say for the first time in a number of years, it's a more interesting international story. And the investment committee has increased our exposure a little bit there in the international area. Certainly the emerging markets benefit from the strength in commodities, and it also plays into value. And so as people talk about growth versus value, if you want to find value exposure, international is a great place to do that. It's got far less exposure to some of these growth sectors like technology and healthcare and is much heavier in finance, industrials, and energy. So do think that this is probably a good opportunity from a valuation standpoint. If you look at the technicals, both emerging market and developed country have pierced long-term downtrend resistance points. And certainly the international story, assuming we don't have mutations and additional shutdown, they look attractive.
Yeah, thank you. I think that was kind of a helpful segue to then just even go here into this last slide and some of the closing comments, as now we're rounding out at the top of the hour and want to be mindful of time. This is not a mistake, even though we had some tech issues. This is a repeat slide on purpose. And the reason for that is we just felt that it was important to come back to this slide because it does highlight so well why it pays to be positive on the U.S. stock market if the data is supportive, and just how rare it's really been for the market to perform, for sustained periods of time, so negative to the downside. And we'll rely on the facts to take us there if that's where we believe we might be headed. So just as kind of a recap for the overall conversation today, we're very positive on 2021, not giddy, I think, as Jeff alluded to earlier. But obviously we'll continue to monitor the data and really use that as our compass as we continue to advise you on our investment recommendations and positionings. And the reason we're ending on this slide is it just helps us to all, I think, reinforce how important it really is to stay focused on the long-term objectives as we're helping you to navigate the goals within your financial plan. Really appreciate, Jeff, you helping to get prepared for this today. Your work's very valued, across the organization as well as for our clients. And wanted to take the time to thank all of you for tuning in today and for the opportunity to serve you. Thanks.
Thanks, Katrina. I always enjoy doing this with you.
Yeah, likewise. We'll be back in July.
Sounds good.
All right. Have a good evening, everyone.